Merry Christmas, Happy New Year, everyone. Joe Vitale with American Retirement Advisors giving you the Gradient Investments weekly market update for the week ending December 23rd, 2022. Hope you all had a great Christmas, and I can't believe we're at the end of the year already. Let's get into stocks. The global financial markets were closed Monday in honor of Christmas Day. Equities were down across the major U.S. indices, with the S&P 500 declining 0.17. The Russell 2000 was down 0.12, and the NASDAQ was down 1.93 for the week. As you see all year, we've been seeing this. The NASDAQ has been down almost 25 to 30% all year. So overseas, the developed markets gained 0.38, while the emerging markets fell 0.24%. In the U.S., energy and utilities were the best performing sectors, while consumer discretionary and technology were the biggest laggards. Fixed income interest rates rose and bond values eased again last week, with the benchmark 10-year Treasury yield rising 27 basis points to 3.75%. The yield curve remains inverted, with the spread between the 2-year and the 10-year Treasuries at 56 basis points, just over 0.5%. Commodities. Silver has benefited from the stronger pricing due to weakening U.S. dollar and positive news out of China on relaxing COVID protocols. The news has led to a potential lift in future industrial production output, sending silver prices 27.8% higher over the past 3 months. It's just over $23 an ounce right now. So economic data, inflation as measured by the Personal Consumption Expenditure Index decelerated to a year-over-year rate of 5.5% or 4.7% after excluding the volatile energy and food categories. In November, and that was in November. This is the inflation rate preferred by the Federal Reserve in its interest rate decision making, and compares to 6.1 and 5.0 respectively in the prior month. Now, new home building permits in November were 11.2% below revised October rate and far below expectations for a 1.1% decline. On a year-over-year basis, permits were down 22.4%. And single-family housing starts in November were 4.1% below the revised October figure and down 32.1% on a year-over-year basis. Existing home sales dropped 7.7% in November, worse than expectations on a deceleration from the prior month. And on a year-over-year basis, sales dropped 35.4%. The driving cause was the rapid increase in mortgage rates, which hurt housing affordability and reduced incentives for owners to put their houses on the market, of course. Meanwhile, the median existing home prices index rose to 370,700, an increase of 3.5% from a year ago. Now, the major index of consumer confidence rose, which is weird, rose 5.1% in December to 59.7 from 56.8 in the prior month. All components of the index lifted, with one-year business conditions surging 25% and long-term business conditions increasing a modest 9%. Now, durable good orders declined 2.1%, a much larger drop than consensus forecast, calling for a 0.8% decrease. Overall, durable orders retreated after 3 months of increases. The index of leading economic, there's a lot of indexes right now. The leading economic indicators fell 1% in November, reflecting weakening conditions in payroll, housing, and manufacturing. This was below expectations of a 5% decline, 0.5%, and following a 0.9% decline in October, with headwinds to economic growth in the coming months. So that's it for that. What's the bottom line to all this? Well, what's crazy is we saw we're going to get the Santa Claus rally, but then we saw the GDP actually better than they thought it was going to be. So all of a sudden the market went back down last week. Why? Because they're worried, oh my goodness, the market's doing good, and it shouldn't be doing good because we're raising interest rates. But what does that mean? They're going to continue to raise interest rates because they're afraid inflation's not coming down. So that's what happened last week. We were thinking we're going to get the Santa Claus rally. We're going to see things going up. But because of actually growth, the market was upset about that because they didn't want that. They want to see inflation's coming down. They don't want the Fed to keep jacking rates. But that's what we're going to see happening next year. So if we don't think we're in a recession, we're in a little recession. Hopefully it's going to be mild. It's not going to be real deep, but time will tell how that goes. But we're already seeing the slowdowns in the markets, especially in the housing market. That's going to continue. Let's get into some company news now. Southwest Airlines, which is a core select and contrarian choice holding, declined 3.19% for the week after it was announced that the Department of Transportation We'll be investigating the company's flight cancellations and operational issues. Chevron, which is a G50 and of course selected and energy holding, rose 5.14% for the week due to an oil price rally on the China reopening news. And that's it. That concludes this week's market update. We want to thank you for being part of our ARA family. To contact us, of course, call us at 855-756-5700. Visit our website, aradvisorsinc.com. Don't forget to visit our Facebook and YouTube pages. Scan our QR code to get our newsletter. Share it with friends. God bless you. Hope you have a great, happy new year. We'll see you next week.